Hi everyone, welcome to this review of the second quarter 2023. Earnings season on Wall Street is in full swing, so it makes perfect sense for us as well to have a look at the portfolio and at the markets during the second quarter. So that is what I will do in this video. I will have a look at the portfolio and on markets, and in the end I will also present to you what I believe will likely happen in the second half of the year. If you have any questions or any suggestions, please do let me know in the comments, preferably in the comments on eToro, so that other people can easily engage in the discussion as well. For those who have only recently discovered my profile, I launched this portfolio around 3 years ago in August 2020. And around 2.5 years ago, in March 2021, I also became part of the Popular Investor Program. And since then, the portfolio has indeed been quite popular, with nowadays more than 5,000 copiers and well over 350,000 people following. So a thank you to everyone who puts their trust in me, and also a thank you to everyone who enjoys my content on eToro. Regarding the investment strategy, I like to keep it simple, so I invest only in stocks, I do not short, and I do not employ any leverage. When I invest, I also consider price very important, and that puts me, of course, directly into the category of a value investor. Nothing wrong with growth, but it also has to come at the right price. The ultimate goal of the strategy is to outperform the market. In particular, I want to outperform European and American indices. And for reasons of simplicity and also adequacy, I compare the portfolio to the S&P 500 on a regular basis, simply because the S&P 500 is really what you can consider the market, and the goal of any investment strategy should always at least be to beat the market, and therefore it makes perfect sense to compare to the S&P 500. Now that is what I did also in this graph. This graph shows you the performance of the portfolio and the index from day one, meaning from August 2020, so roughly over the last 3 years. And you can see that the portfolio has delivered around 70% of upside during that time period. That corresponds to an annual growth rate of almost 20%. And if you look at the S&P 500, during that same time period, the S&P 500 delivered a respectable but still less growth than the portfolio. The S&P 500 delivered 36%, which corresponds to an annual growth rate of plus 11%. Now zooming in a little bit closer into the year, this chart shows you 2023 from January until June. Again, the Ingroq portfolio is in blue, the index is in orange, so we are looking at the first 6 months. Notably, the index has done quite a bit better than my portfolio during 2023. As of the 30th of June, the index is up 15.9% and the portfolio is up 5.3%. During the first quarter, just to think back a little bit, the portfolio was well ahead of the index and performing very well in an environment where markets started to be a bit more optimistic around the future path of inflation and interest rates. The portfolio did even do well during the banking crisis, which started in March. Then the picture changed somewhat during the second quarter. Especially if you look at May and June, you can clearly see how the index is rallying while the portfolio is going the other direction. Now, most of you will know that was mostly related to an AI-driven rally. A little bit more on that in the next slide. So this slide zooms in even a little bit more and shows you the performance of the portfolio and the index during the second quarter. So during April, May, and June. In April, you can see really not that much happened, neither in the portfolio nor on the index level. So we were in a rather low volatility phase. It started to feel like the banking crisis in the United States was starting to be under control, and both portfolio and the index were roughly in line with each other. Then in May, you see the story was a bit different. The index was rather resilient, whereas the portfolio took a dive. The main reason for that was that the general expectation was that we will be facing a recession in large parts of the world. And the portfolio contains a couple of stocks which are particularly sensitive to that. For example, consumer discretionary, commodities, and also telecommunications to some degree. Those stocks all turned out to be rather sensitive to a little bit more negative outlook in the economy. And that is why the portfolio took the hit it did during the month of May. Now in June, the fortunes recovered a little bit, and in June the portfolio was actually able to also go higher, just like the market did, however from a lower base, and that is why the portfolio finished the quarter quite a bit below the S&P 500. Now looking a little bit more in detail into the portfolio, which stocks were the ones driving this result. And what you can see, first of all, if you look at single stocks in the portfolio, is that the range of performance, either to the upside or to the downside, was rather narrow. You see in the top left corner, Vistra with an impact of plus 1.1% on the portfolio. And in the bottom right, you see Signet Jewelers with an impact of minus 1.1% on portfolio performance. So you really see that the spread of how much impact any given stock had on the portfolio was not very wide. It was rather a story of, okay, there is a lot of companies in the portfolio which took a hit at the same time. But we will get to that in a minute. So for now, let's just have a look at the other two top performers during the quarter. The second best performer in the portfolio was Mercedes-Benz. And on that note, I would also like to add that that position is completely closed, with a decent profit, including dividends of plus 46.7%. Shell, the oil and gas company, was also something which held up the portfolio during the second quarter. Surprisingly so, you might add, because actually in the second quarter, markets were experiencing lower prices for oil and gas, which you would normally expect to have a negative impact on Shell. However, Shell was keeping the portfolio afloat despite those headwinds, which I really do see as a sign of underlying strength in the company. Now, on the downside, on the bottom three, it is important to highlight that there are two telecommunications companies, Vodafone and AT&T. There are some general concerns about that industry because there is a large requirement to any mobile carrier in the world, to any telecommunications company in the world, to upgrade their grid, for example, to 5G, which usually costs a lot of money. And there is currently a slight concern in the market that those companies might have to spend a lot of money on those upgrades, on those capital expenditures, also given inflation, and that they might for now not be able to recuperate all that investment. However, if you look at those companies right now, in my opinion, they still produce very strong cash flows and therefore should be able to stem that capital expenditure which is coming, as well as good returns to shareholders. On Vodafone, though, I will make a little remark as well. As I pointed out in one of my monthly reports, that company for me is a little bit more under scrutiny because they had just another change at the top. They just exchanged the CEO again. And so far, the new CEO and the leadership team behind the CEO has not been particularly convincing as to outlining how the strategy is supposed to work in the future. So that one is a bit more under surveillance than other stocks in the portfolio. Then last but not least, just a couple of words on Signet Jewelers. It really is not a big surprise that Signet is ending up in the bottom three performers for that quarter. And that goes back to what I mentioned before regarding the performance of stocks which are very much exposed to the consumer. So jewelry for most people in this world is really something which you don't really need in everyday life. So of course, when prices are going up for everyday goods, you would rather prioritize paying those instead of getting jewelry. So of course, in May, when there was a general expectation of potentially a recession coming in, that stock suffered more than others, dragging down the portfolio. However, I think the company itself is actually still in very good shape and should also be able to outperform to the upside once the economy recovers. Now, looking at the entire portfolio, this graph here shows all the companies in the portfolio and how much they contributed to the result of the portfolio during the second quarter. And you see on the left side the three stocks which I just mentioned before: Vistra, Mercedes, and Shell. And on the very right, you also see the bottom three performers: Vodafone, AT&T, and Signet Jewelers. And I really just wanted to share this slide with you as well in order to show what happened here during the quarter. So in red, with the red boxes, you have all the companies which I would consider economically sensitive. So stocks which are usually suffering more than the average from worsening outlook in the economy. That is Harley Davidson, motorcycles. That is K&S, fertilizer, Lufthansa, airline. Signify, which produces lamps, Vale, which produces iron ore, and aforementioned Signet Jewelers. All those companies, they do less well in an environment where the expectation is that maybe a recession is coming in, and that is exactly what happened in May. However, I invest into companies because I believe in their future potential, and therefore I think that those companies will also contribute quite strongly to the positive result in the portfolio once the economy is recovering. Now, with all that in mind, let's have a look at the last 6 months and also at the next 6 months. So I think it is important sometimes, because there is always a lot of pessimism going around when you look at stock markets. If you look back at the first 6 months of the year, we have actually really come a long way. If you remember, just a couple of months ago, there was talk everywhere in financial media of a rocky recovery, of a hard landing, of recession pretty much everywhere. Now, that is something which has really changed fundamentally in the last 2 months. For example, the US Federal Reserve does no longer forecast a recession in the United States. And also the IMF, the International Monetary Fund, for example, has upgraded the growth expectations for many European countries. So that is really a market shift from just a couple of months ago, where the outlook is really a bit stronger, a bit better for the world economy. Also, the banking crisis. You remember that big scare from back in March, April, and even partly in May. That appears under control. Now, I would not say that it is completely over. I think you always have to be ready that something breaks in the financial system. However, governments and regulators around the world have shown a willingness to do whatever they can in order to prevent any kind of severe meltdown in the financial system. And last but not least, let's not forget about the debt ceiling discussion in the United States, which is now simply solved. So another one which we do not need to worry too much about anymore. That is not to say that there are no challenges. Of course, there are. There are always challenges, especially when you look at it from the angle of financial markets. We still have war in Ukraine. We have commodity prices which are at best volatile, even if they're currently a little bit lower, so that remains a risk. The China recovery, which everybody was expecting from the beginning of the year, is not really materializing. Next one, commercial real estate. There is a large amount of leverage in that system, so there might be many pieces of real estate in our developed economies which are coming under pressure with higher refinancing rates. And that stretches also to other parts of the economy, because overall leverage, if you look at governments, companies, or even ordinary citizens, is rather high, historically speaking. So that is something which is obviously a concern if interest rates are going up as much as they have over the last 1.5 years. So that is nothing to brush over. Those are the challenges which I would consider most severe and most pressing. And it is important to say, however, that while these challenges remain, the outlook really has become brighter. Like I said before, many economists now expect less severe recessions in many parts of the world. That is something which you also felt in the equity markets. Equity markets have started to price in more optimism. And I believe that that optimism will over time also be a good thing for the portfolio. because the portfolio does, in my opinion, contain a lot of companies which are fundamentally strong, and I think they are in a good position to benefit from an eventual recovery in the United States and in Europe. So with that said, that is pretty much everything for today. That is my review of the second quarter 2023. Like I said in the beginning, if you have any questions or suggestions, please do let me know in the comments, preferably on eToro, so that it's easy for everybody to engage in a discussion as well. For now, thank you very much, all the best, and see you soon.